export sector, and they've pushed investment as high as they can push it. And then if you go sort of understand the other part of the economy, what you find is that household income was drifting down and drifting down, partly because of the Lewis effect, to under 60% of GDP. And the household savings rate, because the social security systems aren't that well built and because it's sort of cultural, is 30%. And so most people's estimates of consumption in China is that it's somewhere between 35 and 40% of GDP. Does anybody know what it is in, say, the United States or Europe? 65 to 70. Well, they're not even within shooting distance of any other economy, advanced or developing. Now, if you read the newspapers, you'll hear that, you know, domestic consumption is going to drive the growth on the demand side. Not really drive the growth, but enable the growth. That may be true, but that's the transition that has to have. So the message I want to leave you with, and I'm going to make it sound a little nerdy, is if you know anything about growth theory, you'll know that most of it focuses on productivity increases, Schumpeterian dynamics, and so on. Those things are really important in the long run. But when you spend a lot of time trying to help policymakers and people and countries with these transitions, you discover a bunch of other things. One is demand's important because demand, the composition as well as the level of demand drives the supply side. And if you get that composition wrong, the supply side will follow it. And then you'll have to go through a whole lot of restructuring later on. So what's China in danger of doing? They're not sure how fast household income is going to rise and how fast that consumption is going to kick in. But they have enough weaponry to build up aggregate demand again. They can use leverage without blowing the economy up. This is very controversial now. And the state balance sheet, unlike most of us in the West, is enormous. They have $3.5 trillion of reserves. They own, the state-owned enterprises, 90% of them, that account for half the net fixed assets in the economy. This isn't going to sound very familiar to most of you, because there isn't any other country like this. And they own a ton of the land. So there's no question that the balance sheet's capable of it. So what is the autopilot response to a demand shortfall, given that the export sector and the tradable side is kind of weak for reasons that have nothing to do with them? The answer is invest more. Well, if you invest more, then you know from marginal analysis you'll push investment into the low return territory. In the private sector, you know, that wouldn't happen. In the state-owned sector, it can happen because they don't care about the return. And in the government, the return is the social return, meaning the present value, the impact on the economy, the GDP. And they can push that one into low return territory, and they have been. And they know it. So the thing that scares people now is something like this. The policymakers are smart, and they have a much better sense than most other countries do, and a much more comprehensive sort of game plan for sort of getting through this transition. But they have to keep their hands off the wrong levers. And the two big wrong levers that will distort demand and distort the supply side of the economy are leverage, which will build up domestic demand without income. Bad idea. You should know that, by the way, because that's what happened in Europe and that's what happened in America. That was the distorted growth path we were on, or is a pretty good description of it. And they don't want to use investment because low return investment is a trap. Why? Because you think it's working because it generates aggregate demand. You can build ghost cities, and that employs a lot of people building a ghost city. Trouble is, it doesn't generate any future income or enable the generation of future income. You get the model. So they're not going to do that, and then they're basically going to hope that the other growth engines kick in. And if they don't kick in immediately, you'll see a growth lull in China. And I don't mean to 7 or 7.5, but maybe even a little lower. And markets will panic because they won't be able to tell whether it's a trend or a transition. So I don't know if any of you are investors, but you can expect a little volatility coming up here. What's at stake is pretty much the growth in the rest of the developing world. If you look at the network structure of the global economy, you'll discover this is now a very big hub. China is the largest exporter in the world. Its major trading partners are, by the way, Europe first, America second, and then, but all these other countries are selling in a lot of Africa's growth, which has been, and I don't mean all of Africa, but a significant number of important countries are growing quite nicely, and part of the reason is that they have access to the Chinese market. To give you the idea of the scale, the middle class in China, McKinsey Global Institute estimates that sometime recently it was 230 million people. Their best guess is that by 10 years from now, it'll be 650 million people. So that's 230 to 650, 420 million new people with middle-class incomes and associated demand. I mean, it has to be one of the great opportunities of all time for people, both domestic and foreign, for people who can access it. What about the fragile five, for those of you who follow these things? So there's a very complex set of things that go with growth that will affect the speed of this convergence process, or maybe even derail it, that have to do with how you manage the capital account. Actually, there's two areas. One is the current account, which means how exposed are you to trade, how fast do you take away the barriers, and how do you manage the capital account? How do you manage inflows and outflows of capital in such a way as to promote growth and structural change in the economies without destabilizing them? So one of the things that happened was that when the crises in our world struck, the monetary policy became extremely accommodative, and the purpose was exactly to push people out on the risk spectrum, to drive those asset prices up, to see if you could make us consume a bit more. I mean, there's different opinions about whether it worked or not, but part of that, you know, hunting for a higher return was hunting for a higher return in the developing world. And the developing world had much better fundamentals, lower debt to GDP ratios. Does anybody know what the average public debt to GDP ratio is in the developing world? How about the advanced countries? Well, it's trending up to 100% in the advanced countries. In the developing world, including the poorest countries, it's trending down to 40%. Now, if I asked you 15 years ago, for those of you who are old enough to be able to answer the question, what's the probability that the credit risk will be in the advanced countries and the debt to GDP ratios will be lower by a factor of 2 or more in the developing countries, you would have said, you're crazy. Well, that's the world we live in. But these monetary policies caused a flood of capital to come into these countries. It elevated their exchange rates, drove down the costs of borrowing, and a number of these countries, including Indonesia, Turkey, Brazil, India, who's the other member of the Fragile Five? South Africa. All started to get into an unbalanced pattern. They were running current account deficits, which means they were borrowing money to invest, etc. And then when Ben Bernanke said we're going to stop buying all these long-dated treasuries and agencies last spring, these capital inflows reversed violently. They started rushing out of these countries, and the exchange rates went all volatile. And the sort of, you know, blogosphere commentary was, well, we're going to derail the growth of these countries. Well, the growth of these countries was an artifact of having, you know, very, very low-cost capital. That was all, no, I won't say that, it's impolite. It was nonsense. But the volatility wasn't nonsense. So most of these countries, which are very well managed for the most part, are in a process of sort of reconfiguring themselves. And the message I wanted to leave you with is it wasn't surprising this happened, because nobody's ever had the practice of how to protect your capital account, you know, from extremely unusual monetary policy somewhere else. I mean, this was learning on the spot, learning by doing. And the most important message I want to leave you with is that's the world that most policymakers, certainly in the developing world, but I would argue even in the advanced countries, live in most of the time. The notion that we're occasionally out of balance with a crisis and the rest of the time's just fine is the most dangerous idea I think we have. So let me describe America, and you all know Europe pretty well. So you look at the American economy. We went back and studied it structurally. The message I want to leave you with, and I'm going to stop here, is the composition of demand matters, structure matters. You know, there's lots of ways to have a defective growth path, and it's very important to be able to detect them and stop it before they break catastrophically. The financial sector has something to do with enabling them, so that's an important part of the ongoing research. So look at the American economy. If there are two very powerful forces operating in the world on advanced economies and eventually on all economies. One is technology. It's the information technology and its offshoots is proceeding under the power of Moore's law. You all know what that is. And one of the things it's doing is it's stripping routine jobs out of advanced economies. There's very good documented research on this. And the other big powerful force is globalization. It's getting, for same technologies, easier and easier to move stuff around in the world. And so global supply chains are being broken up into smaller and smaller parts and put exactly where they should be, you know, where there's human resources and a reasonably decent, stable environment. And the combination of those forces in the American economy produced a funny-looking growth pattern. So if you divide, this is true generally for advanced countries, but I'll do it for one. If you divide the American economy industry by industry as best you can into a tradable and non-tradable part, the non-tradable part is mostly services that don't trade internationally. So it's government, education, construction, you know, retail, hotels, foods, restaurants, you know, very labor-intensive things. It's a huge part of the economy. It's 2/3. The tradable part, which is getting bigger as a share, to be sure, is about 1/3. And it's manufacturing and then a bunch of services, like designing computers, consulting, managing multinational enterprises, and a bunch of other things. So in the American economy coming into the crisis, we were generating pretty decent growth on the tradable and non-tradable side, but we generated next to no employment on the tradable side, none. So we created 27 million jobs in an 18-year period before the crisis, and virtually all of them were in the non-tradable sector. Now, maybe that's sort of, you know, what should have been happening. I mean, but it indicates how powerful a combination of this technological. This is happening in other countries, although they haven't noticed yet. It's just part of the employment problem. The other thing that happened is that starting in about 2000, we started to lever up. And we generated more domestic aggregate demand than we did output. Domestic aggregate demand consists of what? Household consumption, private investment, government expenditure on delivering presumably valuable services, and government public sector investment in things like infrastructure and education and so on. That's domestic aggregate demand. And if it's bigger than the GDP, then you run a current account deficit. And we did. We ran it up to 6%. Didn't look like it was a sustainable pattern, and it wasn't, right? And so what happened when the crisis hit? Oh, by the way, because domestic aggregate demand was too big, the composition of demand was off, and the other component of overall demand is external demand. And so what we did is we crowded out the tradable sector at the margin by having too much domestic demand causing composition for our resources. Then domestic demand collapsed in the crisis. And so you asked yourself what the growth patterns are going to look like. Well, the non-tradable side doesn't have anywhere else to go. Non-tradable means you serve domestic demand. If domestic demand falls, the non-tradable side falls, period. End of story, right? You don't have to think about it very hard. And it won't come back until the domestic aggregate, the domestic non-tradable demand comes back. On the other hand, the tradable side, had some external demand, and some of that was growing pretty fast out there in the developing countries. So it's not constrained in the same way. And so if you go actually look at the data in the American recovery, the third of the economy that's tradable has generated more than half the growth. And that's probably an understatement because, for a technical reason, which is it probably generated more of the growth, but the income flows back across into the non-tradable sector. If I make money making washing machines or cars, I don't spend all my money on washing machines and cars. I spend them on restaurants and houses and a whole bunch of other stuff. So this is exactly the same as the developing country model. The catalyst, the big powerful engine, is the tradable sector, but then it spills over and it starts to produce a more balanced growth path on the non-tradable side as well. So that's the American case. And the key input to that, there's more to the story. We have the animal spirit story. That's not wrong. It's just incomplete. We have the deleveraging story. That's not wrong either. That's important, and that takes time. And we're fairly far along, but not done with deleveraging. Until we're done, we won't have demand come back. And it's never going to come back to where it was before. And if it does, you should be afraid, because the only way to get back to where it was before was with leverage. And we don't want to do that, okay? So the notion that we're in a recovery and eventually going to get back to where we were before is wrong. We are going to go to a different growth and better balanced growth path in which the tradable sector is bigger, domestic demand comes back a little bit because of deleveraging, and the key input to that is that there's lots of things wrong on the other side of the Atlantic, not in the northern part, which is pretty well managed, very well managed. Even though the Canadians have a wonderful habit of saying, they get up and these Scots get up and pound the table and say, the thing that's wrong with this country is, and then there's a sort of sentence or he blurts something out. I guess all countries are sort of self-critical like that, but Canada's pretty well managed. The big saving grace in the American economy is it's structurally flexible and dynamic. So it may be too harsh, maybe we don't protect people very well, but when we have to change structurally, either because of these big powerful forces or because we're in some kind of structural component of a recovery, we get there. We can get there even if the government doesn't do anything, which is roughly what it's doing, nothing. The difference between Europe and America in terms of economic performance, other than the peculiarities of the Eurozone structure, which I admit, causes problems, is not that the Italian government is gridlocked and the American government is a model of aggressive, well-targeted action. That's bullshit. They're both gridlocked. The difference is that one economy is structurally more flexible than the other. It is a hugely valuable attribute in the kind of world we live in. It is also an essential attribute in a developing country. And from an academic point of view, if we want to really capture and understand this, we're going to have to add to our growth models these elements. The composition of demand, how it's created, whether it's sustainable, how it affects structure, whether the structure changes. So this country, that we're standing in right now, where many of you live, including me, has a ton of resources. There's nothing, low potential about this economy at all. But there are two problems that need to be solved. Three, actually. One, the euro is overvalued. At 136 to 140, it's pretty hard to imagine anything other than a very long-term draconian change in the relationship between unit labor costs and productivity that could justify this exchange rate. And to be honest with you, this exchange rate is a function of monetary policies outside. I mean, you wouldn't guess that Europe is the sort of safe haven for capital in the global economy, but it is. because the interest rates are a little bit higher, and who knows? Now maybe that's going to change with tapering and the American economic performance. But I remember last summer, the United States had a big outflow of capital after the tapering announcement. This is when Ben Bernanke said we're not going to keep buying $85 billion of long-dated treasuries. And and it was clearly coming out of the developing countries. So I was sort of scratching my head and talking to investment people and saying, where the hell is this money going? Well, the answer was it's going into Europe, driving up the euro. So that's point one. Point two, all southern European countries, starting with the introduction of the euro, had their unit labor costs, with Germany as the reference point, with everybody indexed to 100 to 2,000, just sail through the roof, up 25 or 30%. And that's not consistent with having the tradable sector as a growth engine. Okay? So you have a domestic demand shock. Domestic demand's down. Same story as in America. Now you want the tradable sector to pick up the slack, and it can't. And the third thing, and then I'm going to stop. And the third thing is this economy is not structurally flexible enough. So even if we get the unit labor costs down, it'll take much too long, much longer than it should, for the structure to change, in spite of the dynamic elements in the economy. I hope I've convinced you that there's a lot of interesting things to think about when you think about growth that are slightly deeper than the kind of frivolous stuff you often read in the newspapers. But anyway, that's what I want to talk to you about. Bottom line is I'm kind of optimistic. I think the convergence process will be bumpy, but we're going to get it done, and in the end, we'll probably be beneficiaries. Whether we solve the sustainability problem that I mentioned at the start, I think is an open question at this point. Thank you. Yeah.
So we have time for a few questions. Michael.
Away or not?
Michael Point.
Yes, sir.
I would like to go back to the part of your lecture mentioning the transition growth in China and what might possibly derail it. Because I think it's important not only for China, but for the possibility of China acting as a locomotive for the rest of the world. If it's true that through transition or catching up, most of the growth comes from imitation, perhaps when that imitation is tapering up and the economy becomes bigger and stronger and more resilient and accommodating, its labor force and its educational growth and human capital growth maybe will enable it to innovate, pass from imitation to innovation, which will push the wages up, sustain domestic demand, and also create import demand and sustain the other economies on an even keel. Is that possible? From going from imitation to innovation for China, for instance?
Yeah, no, it's a very shrewd observation. No, it's already happening. It's not happening as fast as they would like, and it's an important part of their, if you like, growth plan. It's embodied in the 12th five-year plan and forward-looking thinking, and so it's a critical element. They have to increase total factor productivity. And that means they essentially have to become more innovative. Part of it's going to come from some more structural change. On the tradable side, they will shed the extremely labor-intensive parts because at $6,000 per capita income, you can't be the low-cost place. I mean, it's happened before. I was in Korea in the mid-'80s when this happened, and they were terrified. I mean, a journalist came up and said, the wages are going up. I didn't know as much as I know now. So I said, yeah, that sounds interesting. And they said, well, that's terrible. And I said, well, what do you mean? I thought the whole point of this exercise was to have rising incomes. And they said, well, yeah, but then we can't compete anymore. This ability to take a static view of the world, which is what you just didn't do, is very powerful in people's minds. So Koreans thought that the only way they would thrive is to keep the low-cost, high-quality, labor-intensive stuff, which, of course, they've shed all of, as has Taiwan, as has Japan, right? And China's doing it right now as we speak. You know, it's a little more complicated in China. It goes up and down the coast and inland, and they build some infrastructure, and Vietnam and Bangladesh and so on. But eventually, it'll get done. And then the whole tradable side will move into a different part of the value-added chain, and that'll be part of it. And along with that will be innovation. So they're trying to kind of figure this out. You know, what are these innovative ecosystems? And they have a lot of different components, and maybe there'll be some uniquely Chinese versions of it. You know, the internet space is extremely innovative in China. Online, you know, the Alibabas and whatnot, Tencents, the social media, the search engines, Baidu and et al. These are very, very innovative. I mean, they're a little bit derivative, but not much. And they may out-innovate lots of the rest of us. So there's pockets of it, and there's a lot of excited, you know, bright-eyed young people busily engaged in that. But, you know, the big stumbling block is the state-owned enterprises. So they have this isn't strictly economics, but this is the core, this and their friends in the party is the core of the high-level corruption. And they know they have to root it out because the credibility of the party, the Communist Party, is at stake, and there isn't any backstop to the Communist Party. There's no constitution that matters. There's no process, you know, that of the type that we all rely on. So they have to win this battle, and the biggest vested interest that's resisting it are the state-owned enterprises, and they don't want, guess what? Competition. They don't want competition. Now just go back to Schumpeter, you know, and Philippe Aghion, who will be here tomorrow, I think, and endogenous growth theory, and ask yourself, how much innovation are you going to get in those sectors, the reserve sectors, without competition? And the answer is not very much. Doesn't matter what the human capital is. I mean, incumbents don't innovate unless there's a unnamed Google sitting in the sort of corner about to eat their lunch. And so they've got to get over that hurdle. But they've got, bottom line is, you hit the nail on the head. I wanted to focus on the demand side because it's coming close to being a demand-constrained sort of situation in the short run. The long-run determinants of growth remain total factor, innovation and total factor productivity growth. Yeah, there was an, yes, sir. Both, yeah, I'll get you both. Yes, sir. Okay.
I think this is a wonderful opportunity for me to request you a question about how we can apply the signaling theory in bringing the right type of growth in both developing and advanced countries.
Well, I don't really, I guess I have to be honest and say that I'm not sure that that theory applies it. It's, signaling, of course, was based on the notion that there is private information in many markets that affects their efficiency and so on. That's the adverse selection effect. And that signaling, sometimes you can cross that boundary a little bit, not with perfect efficiency. There's lots of room in this world for what I might call effective communication. But I guess I wouldn't characterize it as having that kind of peculiar structure that went with the private information. So the essence of signaling theory is that, you know, signals don't work unless there's a negative correlation between the unseen thing that people care about that has value and whatever it is the signal is. So you can't have a costless signal because everybody will use it and it won't carry in for any information.